And in guys, so in today's video, I wanted to talk to you about this absolutely beautiful 1-to-3 risk to reward trade that we took on the pound versus the Japanese yen last Friday. Now, this trade was a 1-to-3 risk to reward trade. However, we took profits early because the news did interfere with our trading. So it did push price in our intended direction. However, because of the news, I told everyone to take profits early and we ended up closing out at a nice 1-to-2 risk to reward. So that wrapped up the entire month of February for us for a solid 11.3% gain overall for the month of February. As you can see, there were 22 trades sent, 8 wins, 3 losses, 2 break evens with a 61.5% win rate. And out of these, there were 9 trades that I had sent that we didn't get tagged into, which is why there's a discrepancy between these and this number up here. However, the point is that we had an absolutely beautiful 61.5% win rate and an 11.3% overall gain on the account for the month of February. So that is really, really amazing. But that is besides the point. Let's jump straight into the analysis of exactly why we took this trade and exactly what we did to make this a beautifully traded setup. Right, so the first thing that we did is understood that we are taking this trade based off of the Judas Swing framework. Now, if you haven't got this framework, then I would highly recommend going down in the description and downloading it completely for free. And whilst you're down there, don't forget to hit the like, comment, and also subscribe. So the first thing that we do is we actually understand our directional bias. Now, the directional bias is key in our trading because it gives us the direction in which the market is going to intend its move. And that's why we can then capitalize on this by taking the trade in this intended direction. So what can we see when we come up to the higher time frame? Now, on the 4-hour time frame, what we can see is that price put in this higher high, this higher low, this higher high, and then price broke this higher low right here, giving us a lower low. Therefore, we have now flipped from bullish to bearish. Therefore, our higher time frame bias is that we want to look for shorts. So once we put in this lower low, we are now getting this lower high building up. And as we understand, after a lower high, we get a lower low. Therefore, because we understand that we should be anticipating a lower low, we can position ourselves somewhere in this region in order to take sales down into some sort of higher time frame area of interest. So having said all of that, on the 4-hourly, we are bearish. On the hourly, we are also bearish because we have broken structure to the downside. And because we've done all of that, our next step is now to identify some sort of higher time frame area of interest where we intend to look for these short positions from. Now, first of all, I've got this supply zone marked up over here. And the reason why I have this supply zone marked up is because this is the area where there was a bunch of orders being transacted. Price was building up. It was doing all of this consolidation. And then we get this crazy move out. We get this push out, which broke structure to the downside, which shows me that there is a lot of unmitigated orders that are open up here, which gives me the insight that price potentially wants to push higher into this area before giving us this lower push. However, what can I also see? I can also see that right here, we've got this fair value gap forming. And this fair value gap is key because this is an area where there was a lot of price displacement to the downside because there wasn't any buyers being transacted in this area. We simply just had an influx of sales which push price lower. Now, this push actually broke structure to the downside. So this is a very key area that we can potentially see a reaction of price from. So I'm going to mark this out and I'm going to make this a supply zone because this is our fair value gap. And that way we can kind of see what is going on when we drop down to the lower time frames. Now, even on the 15-minute time frame, if I replay the charts, this is what we were seeing when we woke up earlier on in that morning. So this is exactly how we were looking at the trade setup. So now that we've understood our directional bias on the higher time frame, we can move on to our next step. Our next step is to understand that the Judas swing happens at the end of the Asia session between the times of 7 a.m. and 9 a.m. UK time. Now, this is something that you have to configure to your own time zone. If you're not in the UK, change this accordingly. But for me, I have to see the Judas swing happening between this time zone. If it doesn't happen between 7 and 9 a.m. UK time, then I won't bother looking for a trade because it is out of the trading window. Then we move on to the next step, which is to mark out our Asia session high and also our Asia session low. So we do this by marking out the zones between midnight UK and 7 a.m. UK time. So again, update this according to your own time zone. And once we mark this out, we're simply just going to wait. We're going to wait for a sweep of either the high or the low before we move on to the next step. So let's just quickly mark that out. So this would be our Asia session low. And the reason for this is because this is the midnight candle. And the reason why this is colored in blue in the background is because I actually use this indicator by Rob Minty. It's called the Asian Session Range. And all this simply does is, instead of me having to mark it out like this, it just colors in the background so I know exactly where I'm looking at. But you don't have to use an indicator. I just do it to make my life a little bit easier. And all you can simply do is just find your midnight candle, which is right here, your 7 a.m. candle, which is right here, and mark out the lowest time or the lowest area of price and the highest area of price between these two time windows. Now that we've got this marked out, we can see that our low is here and our high is up here. So our next step is to wait for a sweep. So if we go back to our checklist, we're going to wait for a sweep. Once we get a sweep of either the high or the low of the Asia session, we're going to drop down to the 1 minute time frame, and then we're going to wait for a market structure shift. Now, once we identify a market structure shift, we can then move on to the next step. However, let me go back to the charts really quickly and show you guys that once we got this sweep up, not only are we going to wait for a market structure shift, but we're also now going to wait for price to push a little bit higher into our area of interest. Now, the reason why we're going to wait for price to push higher is because if we get a market structure shift before pushing higher, we know that this could be liquidity which is getting induced into the market for it to get taken out before we get this actual push, and then we get our move that was intended. So because of this reason, what we're going to do is we're going to wait for price to push up and come into our higher time frame area of interest before we start looking for a market structure shift. Now, if I drop down to the 1 minute, what we will also see is that price will have a tendency to give us some sort of fake market structure shift in order to induce buyers and sellers into the market. So what we're going to do is we're actually going to jump up to the 5 minute time frame, and we're just going to start trailing the markets with our market structure shift point. So this is where it would be for me personally. So I'm going to wait for this to break before I start looking for an entry. So let me play price on. So now that we can see that price has given us this market structure shift, what we can do is now go back to the checklist and start looking at our next step. Our next step is to identify a fair value gap. Now, once we get the market structure shift, we need to identify our fair value gap in order to take an entry. And a fair value gap is simply when we have exponential price displacement to one side. And I've given you an image up there so that you have some sort of reference point to go back to. So in this instance, what we're going to do is we're going to identify our fair value gaps. And as we can see in this leg of price, what we're seeing is that we've got a fair value gap there. We've got a fair value gap there, and then we've also got a fair value gap right there. Now, because we've got 3 different fair value gaps, how do you know which one you're going to enter from? Well, the short answer and the truthful answer is nobody really knows what fair value gap is going to hold. And if somebody comes on here and they do tell you that they know or they have the magic method which is going to show you how to identify the correct fair value gap, they're lying. Because there is not one person that can tell you exactly what area is going to hold, because they are not the market maker. Therefore, because we don't know what area it's going to hold, all we can really do is start to add confluences to give us more confidence in why a particular fair value gap will hold as opposed to another one. Now, if we take a fib and we measure from the swing high to the swing low, what we can start to identify is that anything below the 50% is now the premium zone. Therefore, this is not something that we're interested in because it is most likely not going to hold. Anything above the 50% is now discounted pricing. Therefore, we know that there is a higher chance of this being respected than something that is within the premium zone. So let me quickly remove this fib. So now we have 2 fair value gaps left. Now, the first fair value gap has this sort of order block to the left, which is a breaker block. So this could be a potential. However, it is on the 50% line, and I'm more inclined to go with an extreme fair value gap as opposed to one that's further down, because not only will this give you a higher risk to reward, but it also means that price has to travel a longer way, showing the intent of it wanting to go in the opposite direction. Therefore, this is the fair value gap that I had marked up. And the reason why we actually got to this stage, which I don't think I explained, is because we had this sort of market structure shift right here. Now, why did we have this market structure shift? Well, if we look at overall structure, what we can see is that price printed this higher high. It then printed this higher low, and we had this higher high. We had this sort of inside structure, internal structure, which is nothing valid. So then once we put in this higher high, our break of structure or our market structure shift was right here. So once we broke to the downside, that is now our market structure shift, flipping from bullish to bearish. Therefore, because we flip bearish, our next intention is that price will give us a lower high before a continuation lower. Therefore, we've now identified our fair value gap, and this is now where we're going to be taking our entry. And just going back to what I was saying earlier about price wanting to induce buyers into the market and sellers into the market before taking them out, if we drop down to the 1 minute, what we can start to see is that there was no sort of internal break of structure. There was no sort of market structure shift which was valid, because all of this price action was just inducing sellers into the market before the market took them out, right? So what can we start to see on the 1 minute? Well, on the 1 minute, this would be our higher high, higher low, higher high, and then price break structure gives this sort of entry right here. And then what does price do? Everyone who's entered in here and has their stops somewhere above here, price comes up, takes them out before giving us the actual move down. This is why I switched to the 5 minute, just because it clears a lot of the noise that's happening on the 1 minute, and it gives us something easier to look at. So now that we've gone off on a tangent, let's come back to the trade at hand. And what can we see? We've identified our fair value gap. Now our next step is to simply take our entry at the start of the fair value gap with our stops above the most recent high, and we always target the opposing liquidity. So in this instance, we're simply going to put our entry right there, stops just above the high, and we're going to target the opposing liquidity, which is the Asia lows, making this a nice 1 to 3 risk to reward. Once I identified all of this, I did send this as a signal in our VIP group. And then after this, price decides to do a whole load of nothing. As we can see, price comes into our area of interest, tags us in, and then it just starts chopping around for a while. After it started chopping around for a while, it was very close to our stop loss. It's chopping around, and then finally it decides to blast down. Now, when we got this initial push down and we ended up breaking this low right here, when we got here and I started to see these wicks, this is when I told everyone that I'm actually going to be taking heavy profits and moving my stops to break even. So I took about 80% off the table at a 1 to 2 risk to reward, and then I started trailing my stops. And I started trailing my stops on the 1 minute sort of structure, which again wasn't very clear, but I was trailing my stops right above this wick here, and then price took us out right there. So this was a nice 1 to 2 risk to reward trade, and it was nicely managed because we started to identify that price was having this slowdown of momentum, so that we took some partials, we moved to break even, we trailed our stops, and then we got taken out. And then once we got taken out, price then did decide to go back up, and had we not gone break even, it would have took us out of break even anyway. And then price did also decide to go up and take out the stop loss. However, we did manage to trade perfectly well in this trade. We followed our checklist down to a T. We made sure that we understood our higher time frame bias, and then we followed all of the steps of the Judas swing. So I hope you guys had good insight from this video and learned something valuable. And if you did, please don't forget to leave a like, comment, and subscribe. And I will see you guys in the next video.